Good afternoon, everyone, and welcome to a special edition from the team at True Potential. This afternoon, we'll look back at some of the comments from the budget today and how that's impacted asset markets. So over the past number of, week to 10 days, there's been a lot of speculation about what the Chancellor Rishi Sunak would discuss today. A lot of it seems to have been very well flagged in the press, but clearly the starting point for all of this is really a difficult situation for the economy, in the sense of the support that's been required to navigate the UK economy through the worst of the COVID-19 pandemic and the associated impact that that's had on the government's finances and the country's finances. If we look at some of the numbers that have been put in place and discussed today, the Chancellor discussed that there's been some £407 billion worth of support provided to the economy. If we look at what that has translated into in terms of overall debt levels, and we think about that, public debt is close to 100% of national income. And that's got us back to a situation that we last saw in the UK probably in about the late 1950s, early 1960s, as we were still dealing with the debt that was there from the Second World War. So that gives you a real sense of the magnitude of the support and the challenge that presents. But clearly, what it does present also is opportunity, how to deal with that. One of the best ways to dealing with the challenges of debt is to really bring growth into the economy. And we'll discuss some of the measures there that have been suggested today that could be helpful in that regard. So just looking at some of the comments that Rishi Sunak has made at a relatively high level, we'll run through a couple of points really. The first is around further support from a COVID-19 perspective. So what can we see there? We can see an extension of the furlough programme due to end at the end of this month. That has been extended through until September of this year. Albeit, as we get towards the end of June, the programme will gradually taper back in terms of the facility that's offered to businesses, but a real extension of that programme. And that, I suppose, is important to the extent that as the economy starts to reopen, job creation will come back and will support those industries. But really it should prevent quite a significant drop-off in employment levels as the furlough programme was due to expire. So that should be a positive from that perspective. Indeed, as well, with that extension of the furlough programme, there was a movement to ensure that it was a bit broader for those that are self-employed, and that again should help those individuals navigate their way through the next number of months. In terms of just commentary that was very specific and made within the budget, the Chancellor did touch on that it will take a long time for the economy to recover from the extraordinary situation that we face today. So he then did go into providing a number of packages that will support that recovery and should support growth in business activity going forward. So there was grants made available to both non-essential retail, but also to the hospitality and leisure sector. Again, those sectors most impacted. The business rates, there will be the business rates holiday will be extended until the end of June, and then we will see a reduced rate payable for the remainder of 2021. Looking then at the housing market, we've discussed on morning markets over the past number of months the strength in the housing market. Indeed, when we look at the annual rate of change in house prices, some 6.97% in the latest survey, that's been supported by the stamp duty holiday. That was expected to expire. That's now been extended as well until the end of June, and the floor for the payment of stamp duty at some £250,000 as well. So again, support to the housing market, support to the developers and the home building industry as well. VAT, another important factor that has supported the hospitality sector. Those cuts that are in place today will be extended until September, and then we will see a VAT rate for hospitality and leisure moving back up to 12.5% for 6 months. Again, support to those areas of the economy that require it. And then just looking at taxation, I suppose this is the double-edged sword. We've got some of those benefits coming through and the support coming through, but there is in the budget there is included some taxation measures that will see an increase at a personal taxation level. It's a bit of a stealth increase really, in the sense that the tax threshold will be held constant at £12,500. That's through until 2026, but with salary adjustments etc. that come through from inflationary adjustments, that will result in a higher level of tax for individuals. Looking at it then from a corporate perspective, again, coming with one thing, taking away in the other, we've got a corporation tax increase, quite a material increase here, from 19% as it stands today to 25% by 2023. So quite a step change in the taxation environment for corporations over the period. That aside, there is some tax relief for businesses coming through over the next couple of years in terms of the investment they make. So getting tax relief, I think, up to some 130% on their investments. But again, is that sufficient to offset the corporation tax increase? Remains to be seen. I'm sure we'll see a lot over the next couple of days discussing that. It doesn't strike me that it could be, and a tax on business will, I think, in some ways curtail their abilities to invest as well. So we do have to keep that in mind. So a difficult balancing act to be struck there, but corporation tax increasing as a result. Just a couple of other points really to mention in closing. Establishment of free ports in terms of making it easier to trade, easier planning restrictions in 8 locations across the country. And then just the Office for Budget Responsibility provided some figures as well, just with alongside the budget, basically talking about a speedier recovery than they had initially expected. They're seeing unemployment now peaking at 6.5% as opposed to 7.5%. Also, if we think about economic growth, they're suggesting that the economy should grow some 4% this year, and into 2022, further growth, something I think in the region of 7 and a bit percent that they're discussing there. So a faster improvement than they had been anticipating before. Just in terms of market reaction, what have we seen? Just looking at how gilt markets have performed, we've seen gilts move out a little bit, so out 9 basis points to around 0.77%. I suppose recognising that maybe recovery is coming slightly faster than expected. Looking at sterling, pretty much unchanged. A lot of what we've been discussing here has generally been flagged over the past week or so. And then in the equity markets, probably more of the small and mid-cap sector performing well on the back of some of those incentives, but also really the home builders being some of the better performing shares as well, given the extension of the stamp duty relief. I'll leave it there, and we'll have some more commentary in Morning Markets tomorrow. Many thanks.
Subscribing to True Potential YouTube channel is quick and easy. Simply go to your YouTube app on your phone, type in True Potential and press the red subscribe option. You'll then be notified as and when new videos are released.